Welcome to the Gower Crowd podcast, syndication in the digital age, with me, Adam Gower, and today's guest, Brian Daly, the co-founder and CEO at GROUNDFLOOR. Now, GROUNDFLOOR is a real estate crowdfunding platform with a twist. Here are some of the highlights. First, the deals that they finance are loans to fix and flippers, and they grade each loan that they make, which is an interesting differentiator. Second, their minimum investment is $10. Isn't that incredible? $10. Third, they allow both accredited and non-accredited investors to invest, which is okay, cool, but not entirely unique. But fourth, what really makes them stand out is that even with only $10 to invest, you can actually identify a specific deal to invest in. Not a fund, but you can take your $10 and say, I want to invest in that project there. Now, I've had the pleasure of having Brian on the show before in a prior series, but this was the first time that we met, so to speak, by Zoom. And I must say that I really enjoyed seeing him because I didn't realize how much energy and enthusiasm he exudes in person. He is very insightful about what's going on in the market today, is an innovative and creative leader in the industry. He has good insights into best practices for raising capital online, especially during challenging times. You are going to love what he has to say today. For my part this week, I've been absolutely, completely immersed with a massive advertising campaign that is quite delightfully consuming almost every minute of the day while we push into 2 weeks what we usually would do in a year. So I need to get back to that. But naturally, cannot conclude a guest introduction without asking for a small favor of you, if you don't mind. If you enjoy these podcasts, would you mind going over to iTunes or whatever podcast channel you listen on and leaving a review? Even if it's just a star review without comment, though having a comment obviously is even better. But even if just a star review, that would be fantastic. I don't think I've asked for reviews before, so if you do get a chance, I'd really appreciate it. All right, so now from the only person that I know in the country with whom you can make a commercial real estate investment with a mere $10, though I'm sure you'd prefer you added a few zeros to that. My guest today, Brian Daly, co-founder and CEO of GROUNDFLOOR. Brian, it's a pleasure to see you. Thanks so very much for being with me. Actually, I'll move my mic over here so it's a little better placed. It's good to see you. You've got some very exciting things going on. You have a unique platform in the real estate crowdfunding space. But before we get into the details of that, sure, there is a big banner on your website specifically that says, "We were built for times like these." Tell me about that. What does that mean?
Yeah. Well, it's really good to be with you. I think this is a really interesting time for all of us in real estate and in real estate finance. We started our company. I met my co-founder in 2012. He had just finished working on the 2012 Jobs Act, which of course liberalized capital formation in a way that enabled different types of crowdfunding, actually. And real estate has been a very successful sort of story within that. Part of the reason that was all happening in 2012 is because of what happened in 2008 and 2009. And our company was born out of that. When we looked at what happened in capital markets during that time, we realized that part of the failure of capital markets then, and honestly, part of the failure in capital markets now, with what's happened during the pandemic, is a structural one. And we had a very specific vision for how that structural shortcoming could be addressed. And we created the company to do that. So when we say we were built for times like this, what we mean by times like this, we mean in times when REITs have suspended redemptions, locking up individuals' capital when they most need and want liquidity, when they as an intermediary, even a well-meaning or constructive intermediary, have put the hammer down of their intermediary power over their individual investors, when large institutions who buy paper, which originators like GroundFloor or others in our space might use in order to allocate capital to sponsors, you know what they all did? They stopped buying paper at precisely the time when people needed them to continue buying paper. And they literally locked up the market, not because they thought the market was in trouble, not because of primary concerns about the health of the real estate market, but because they had faced redemption requests, they faced margin calls, and they faced fires in their portfolios. Those are not primary and substantively valid reasons. Those are structural problems. And I'm going to tell you, 7 years into building this company, we know that the vision we had for retail investors having all the rights, prerogatives, opportunities, and power on a level playing field with the hedge funds and the big banks, we were right. Because you know what? Retail investors don't have margin calls, face liquidations. They don't have the same structural deficiencies and problems that institutions who are applying inappropriate levels of leverage to their funds have. And so when we say we were built for times like this is what we mean. We think a capital market structured this way, the way that GroundFloor is structured, is more pliable, more durable, more flexible in times like this. And it's true. The data is bearing it out.
Yeah, and so actually this is actually perfect that you should answer that, because it rolls straight into what I had already typed up as my second question. And that was that basically, just kind of dumbing this down a little bit.
Sure.
But basically what happened during the last downturn was that banks stopped lending, right? They stopped lending as well. Right. So you had this desperate need for liquidity, but there was no liquidity. And at the same time, of course, retail investors couldn't do anything. Right? There was no way of accessing these markets. There was no company like GroundFloor that was able to kind of intermediate between investors and borrowers, and in your case, single family homes. So for that one guy in the audience that doesn't know that, single family homes. So have you seen that same with this particular downturn? Is that the same trend that you're seeing now, that banks have stopped lending and that you're filling a gap, or are you seeing something different? Is it a bit different this time?
It's different. It's different this time. It's always different, right? What's consistent is that capital markets that are built on a house of cards always come tumbling down, right? The way they come tumbling down, which Jenga block, fails in the capital markets house of cards, always is different. In this one, it's not the banks. It's not the banks that are at fault. Especially in our market, the banks aren't lending in our market anyway. They don't make loans on individual short-term, real estate investments that are, backed by, that are, projects that are single-family housing renovations, right? It's not a category in which they're active, right? What happened here instead is the large institutional buyers of paper who buy that paper from originators, right, stopped buying. And the other thing they started doing was requiring, ridiculous terms like 12 or 18 months of interest coverage, while simultaneously reducing leverage from a standard of about 65 to 70% to 55 to 60%. So the effective leverage would be less than 50%. That's very damaging to a real estate entrepreneur, right? The sponsors in our audience here know that, right? To not be able to achieve the leverage really limits your ability to take on projects, right? And by the way, that has a terrible effect on the economy as well, right? I mean, this all rolls 3 and 6 and 12 months downhill in a really deleterious way.
So I went and I had a look at Seed Invest, and we'll talk about that in a little bit.
Sure.
It's a fabulous video there. I'll definitely put a link to it on the show notes.
Thank you.
It's a very good video. And one of the things that was mentioned in that video, I'm not sure if it was you or Nick, but basically so one of you said, we see opportunity in volatility. Opportunity in volatility. Walk me through that from your perspective in this environment that we're in right now.
Sure. So, look, we offer a debt product, right? That's very different from an equity product, right? If you're an equity holder in a time like this, you're in the first loss position, And so if assets decline in price or because of a liquidity crunch, they have to be sold at an inopportune time, you just think of having to sell a stock in order to pay your bills, right? For example, that's a classic example. You can really lose a lot if you're an equity investor. By the way, as an equity investor, if you are buying at the bottom in real estate or any other category, you can gain a lot. And so that's one form of opportunity and volatility. Here's another one. When you're a debt holder, you have two advantages going for you. One, you're owed the same amount of principal back no matter how the price of the asset performs, right? Now that's an opportunity because you are taking less risk as a debt holder, but you are earning relatively higher returns on balance on a shorter time frame than most equity investors are. So when we think about opportunity and volatility, there are two forms of that. One is equity investors have opportunities if they're willing to take the risk, but debt holders have opportunities to make returns that are relatively high relative to what their equity investors are taking for a much higher risk, but just by being consistent through the process. And so the opportunity that we see in volatility is we see much better credits coming our way, right? More experienced borrowers. We see much better collateral coming our way. We see our borrowers who are the equity holders getting to buy for depressed prices and then making more profit and therefore helping us make loans that are fundamentally more secure. So people kind of misunderstand. They think, oh, volatility is scary and that's bad. And that may be true if you're an equity holder who needs liquidity, but it's great if you're a lender, right? It's great if you're a lender.
That's really interesting. So did I hear you correctly that you said you are seeing higher credit borrowers bringing discounted deals to you during this current?
Much more.
Really?
Because access to capital has gotten crushed. So there are fewer places to go for capital. If like GROUNDFLOOR, you actually have capital to lend on advantageous normal terms. I mean, people will say they have capital to lend, but the terms are hideous. If you actually have capital to lend, the borrowers have fewer places to go to get terms that are attractive to them. And so we've just seen a real increase in sort of the quality of deals that are coming our way, which I think is just a function of how many alternatives there aren't in a market like this.
That's really fascinating. So you're able to be more selective then, are you, during this time, and pick the better deals than?
Yeah. And I think these times are more favorable for experienced investors as well, right? Because they're experienced investors know what's the Warren Buffett statement, price is what you pay, value is what you get. Right. And they're careful and discerning about that. And so they've been waiting for moments like this, and they have the cash and they have the capital to go in and take advantage in a way that I think newer investors or newer sponsors may find it harder.
So tell me something. Yeah, I'm interested. I'm not actually a single family guy, but I'm fascinated because, it's the kind of the undercurrent of everything that is real estate, right? I mean, it's a key indicator.
Well, single family is the place where a lot of investors or sponsors get their start. Right.
So my question is, are you seeing, where is the opportunity coming? Is it coming because people are losing their homes or defaulting on homes, and that's providing a downward motion on pricing? Or actually, are you seeing a flip side of that? Are you seeing higher demand for people moving into them? Like, what's going on actually?
Well, so what's happening is both supply and demand have declined, but supply was already depressed relative to demand. So they've moved down, in our view, in most of the markets where we are, we see that supply and demand have both taken steps back, but that really supply has actually been constricted more than demand. And so that's interesting because we have thought that over time, if this recession extends for a long period of time, people may be forced to sell their house for less. We don't know, right? Because truly the price is going to be determined by the balance between supply and demand. The truth is there's so much long-term demand that has built up relative to the shortfall in supply, that it would take a very long and very deep recession indeed to depress house prices. So go ahead.
Well, I was going to say then, so the logic is therefore if supply has gone down and demand has stayed the same, or at least has come down less, that there would be increased pricing on the existing stock. And yet you're telling me that there are opportunities for single family home renovators, fix and flippers. So explain that. Doesn't quite match.
Here's and this goes back to the point about opportunity and volatility, right? This is what I was trying to say about an equity holder with cash and who knows what he or she is doing. You know, there's an opportunity and volatility because even though on a macro scale, prices may be increasing, there are spots and situational factors because of the volatility, because of job losses in a certain area or, regionally or in a neighborhood, right? There may be specific factors in a place that are driven by the volatility that create that opportunity for an equity buyer to go, who has the resources and the experience to do it, to go in and take hold of that. But it really plays to the strength of an experienced investor to know, or sponsor to know where that is, to have the resources, the human resources as well as the financial resources and the talent to go in and the vision to go do that. But that's what the great entrepreneurs do. They did it in the last downturn too, right? I mean, that's where you really learn how good of an entrepreneur you are, right? Is spotting those opportunities and being there at the right time.
Exactly. Getting actually through a downturn, not just surviving it, but really taking off during it. So tell me something about investors. We've talked a lot about the supply and demand on the borrower side.
Yes.
So what are your investors looking for? The people that are coming in with $10, an amazing number.
Yep.
Presumably there's a lot more people that invest more than just $10.
Of course.
But what are they looking for? Are they looking for yield? Are they looking for secure? Well, tell me something about that. And how has that changed during the downturn, Brian?
It has changed during the downturn in really interesting ways. I will say last month we did a record month, which surprises a lot of people. We did a record month of investment volume. But when you look at the breakdown of the type of investing that people are doing, it really shifted. It changed, it inverted. So taking one step back, the reason we have this $10 minimum is not because we think, people only want to invest $10, right? We did that as an intentionally low barrier to diversification because we understand that the way the hedge funds make money is by spreading their assets, their investments across a great number of loans or of equity investments. And then if some of them don't work out, that's okay because it's counterbalanced by some in the portfolio that really work out very well. And that's true with our loans graded A through G, right? An A loan is, going to be only pay 8%. A D loan is going to pay 12%, right? And so on. So that there's more leverage and maybe more risk or exposure in those higher grade loans. But the idea is we want people to allocate and take on the risk that they're comfortable with, but spread that risk across grades, spread that risk across geographies, across different types of loans. And you get to do what a hedge fund manager does. And you get to earn the returns that a hedge fund manager earns.
All right.
Now,
I'm going to interrupt you because you were talking on to that, and I want to get back to that. Yeah, but you were talking about what I was fascinated in was the inversion. You've seen some
the inversion.
Yeah.
So I wanted to lay that groundwork because that is the main modality on ground floor is that people are allocating money into these loans and building portfolios of loans. We have also launched a new product and we've been testing it over the last year and we started to ramp it up in response to demand. That is a short-term note investment. And when I say short-term, our normal loans are 6 to 12 months. These notes are 1 to 3 months. And they pay, unlike the investments in our loans, right, where you are repaid when the loan repays, these notes are repaid on a certain date. In fact, every note has a date in its title, right? And it says this is the June 1st ground floor note, and it repays at a certain rate of interest at a certain time. And instead of being backed by one project, it's backed by a pool of projects that we've originated, loans that we've originated that haven't yet been funded by the crowd. So it's a different profile of investment because it's shorter term It is backed by a pool of paper instead of just one project. And by consequence of the shorter term and the lower risk profile, it pays a smaller yield. So the yield is more like 4 or 5% per year instead of the average of 10.5 or 11% that people earn investing in the longer term, relatively higher risk individual loans.
And so, and that's a presumably then a lower risk, higher liquidity product. Is that
correct?
Right?
Yeah. And I think if you compare it to a portfolio of ground floor loans, different people will disagree about which has better liquidity features and whatnot. But if you're just looking at side by side, the ground floor notes pay off sooner at a date certain, backed by a package of loans or a broad number of loans.
And that's because that broad number of loans have different maturity dates.
Correct.
So they're constantly maturing.
Well, and our takeout for those loans is funding them through the crowd, right? So we turn over that capital every 30 to 60 days.
Oh, I see.
And so we can provide 90-day terms or 30-day terms to our investors. So that creates the opportunity.
Oh, that's
for people who are worried about their jobs or the economy and they just want to stash away some money for 30 days or 90 days when they might need it, right? Or maybe they just want to be opportunistic in the market, right? Maybe they want to do a transaction or buy a house or invest in a property or dabble in the stock market or bet on options, right? Calls or puts, right? They may want to put it away for 30 or 90 days while they wait, and at least they're earning something. They're earning 4 or 5% annual rate.
Really interesting. So what have you seen then during this downturn? Are people on the hunt for yield?
Oh, sir, people are on the hunt for liquidity and security. They've kind of stopped hunting for the highest yield. They just want to know that they're going to be repaid, that their money is safe. And the appetite has definitely changed in the market, right? People are being much more fearful than they're being greedy. And, if you listen even to the Federal Reserve, there's ample reason to take a protective posture. And that's why I think it's good on our platform. Some people are more aggressive, right? Some people are more aggressive and they say, no, this is the time when I'm going to make a ton of money. And they'll invest in higher risk loans on the theory that maybe they're going to earn some default interest, right? Because when our loans go into default, you earn an extra 4%, extra 2, 3, 4% while it's in default. And a lot of investors have come to really like that, because they know in the end, it's probably not going to be a loss. It's just going to be extended and they're going to make extra return.
So when you talked about seeing an inversion, does that mean, and where I thought you were going to go with that, understanding this fabulous grading system that you have. Sure. So a grade A loan, first of all, you finance them put it on your books, and then you basically backfill with the crowd, or you sell to the crowd.
Yep.
So a grade A is, comes in at the lowest interest rate all the way up to a G, which is the highest interest rate, which presumably indicates the level of confidence you have that things are going to finish the way you want to.
Right. Yep.
So what I thought you were going to say when you talked about inversion was that prior to the downturn, there was higher demand for the C, D, E, F, and G's or whatever.
That's true.
Than there were for the A, B's, and C's, and it actually shifted. Is that what you're seeing?
Well, and there are two forms of inversion. You put your finger on one. The one I was talking about is the inversion between investing in notes versus loans, right? It used to be investment in loans was 2 to 1 on notes. Now for a short time it inverted. Now it's kind of equalizing. Okay. But it inverted between loans and notes, sort of shorter term, lower risk. And that's also true, I'm glad you pointed it out, in the grades, because it hasn't quite inverted, but we've seen demand shift more. There's more appetite for the lower yield, lower leverage loans, the A and B grade loans.
The more appetite.
Relatively more, yeah. It hasn't inverted, it hasn't completely shifted, but we've definitely seen a change there.
Interesting. And so how is your messaging changed? Now, let's talk about that in a minute. But actually, I would like to talk about your $10 minimum. I did cut you off when you were talking about that. And I always get into trouble for interfering.
Sorry,
can you hear me? You hear me okay?
Now I can. Can you repeat that?
Yes, so I always get into trouble when I interrupt, but I wanted to talk to you about your $10 minimum. It's very
Yeah.
interesting that you actually think of that as a divestment tool for investors. You know, when I first heard of the $10 minimum, it actually struck me as being sheer genius. And the reason for that, especially if you are appealing to a non-accredited audience, which is a very unusual thing for any platform to be doing, right? You're one of very few that do that.
Right.
But the reason that it's so fascinating is because it appeals to a different audience, say a millennial audience.
Yep. It's true.
And the millennials are those who are said to be less wealthy than their baby boomer parents.
Right.
But if you're able to get that demographic in, even at $10 or $100,
Right.
And they start to invest a little bit more year after year because they get used to the platform, they start to like it, etc.,
Right.
etc. Hey, guess what? They're the generation that are going to inherit the baby boomer
That's true.
wealth. And when they get those inheritances, where are they going to go? They're going to go where they've got so comfortable for the last 10, 20 years investing.
I think you're putting your finger on something that's very important about the $10 minimum, because it does make it more accessible to people. It also makes it healthier to those people when they access it. So if I'm going to invest $100, and if our minimum were $100 instead of $10, you could only invest in one loan, right? If that were our minimum. If our investment were $1,000, you might not be able to invest at all, or you might really struggle to get that $1,000 together, and then you could only invest it in one loan. Well, I hope those eggs are safe in that one basket, you know? And that's not how Wall Street does it. That's not how Wall Street makes high returns at low risk, right? That's just not how they do it. And so what we want to do is give everybody those same tools, no matter how large your portfolio is. And there's a structural difference that's important to millennials, since you bring them up. Millennials, for good and valid reasons, don't trust intermediaries. I'll give you an example. A lot of millennials invest in some of these e-REIT products. I won't name names because I'm going to say something kind of negative. But a lot of these millennials have bought the online kind of pitch from some of these e-REIT products, right? And the e-REIT products, when the pandemic hit, even if you asked for your redemption back in December, they said, cool, we got your redemption request. Let's say you were going to buy a house, or you were saving for a vacation, or you wanted to send your kid to college, right? And you wanted a redemption. They came up and they said, cool, we'll give you your redemption in April. That's our next redemption period. And then, which is annoying, right? I mean, who wants to wait 3-4 months for your money? But okay, let's just grant them that. They got to run their business. Well, then at the end of it, on April 4th, this one platform messaged everybody who had asked for a redemption in the previous 3 to 4 months and said, nope, sorry, you're not getting your money.
All right, Brian, so a redemption means...
We've decided to suspend redemptions.
Right.
You may not have your money. And what they did is they went to the fine print of their offering and they said, see, we told you this is a long-term investment, and we told you that if the economy contracted, we would suspend redemptions. And we wrote a letter to you, at the end of last year and 2 years ago, and said we were going to do this. But people don't care, because this is exactly what people fear, is that once they do entrust a new intermediary, that they're going to screw them over too. And just because you told me and you disclosed it doesn't mean that I don't feel
it should
screwed.
Happen. Exactly.
And there's a better way, because that's not what Wall Street does. Wall Street doesn't have to turn their money over to somebody else who gets to lock it up. Wall Street has power. And we're taking that power and we're putting it in the hands of every millennial, every baby boomer, every Gen Xer and Gen Yer, and in the next generation to come, because that's how a capital market should work. And people are tired of intermediaries taking the piss. That's what's happening.
I love you using a nice English colloquialism. So redemptions, let's just drill down on this and then let's talk about investor acquisition because it's very interesting.
Sure.
So redemptions means that when you invest in an e-REIT, you are locking your money up, ? In your case, it's the same thing though, isn't it? If I invest in, if I put $100 or $1,000 in a loan, I have to wait for it to mature before I get my money back.
No, it's not the same thing at all.
So explain to me the difference. Yeah.
Here's the difference. Yeah. Because structurally, you're not turning over $100 to us and we're telling you when you get your $100 back. You're taking your $100 and you're spreading it into 10 loans. Now, if you did that, our data shows if you invested in a couple of loans every month for about 6 months, the data shows empirically that pretty much every month, one or more of your loans is going to repay.
I see.
And that's even more true if you invest in 100 loans over the course of 6 months. And so the point is, instead of the fund manager having control, you have control. And you have control because you can decide how much you invest in each loan, what term. Like on our website right now, we show you exactly how many months it is until that loan is due to repay. So if we did a 12-month loan and the loan wasn't funded until 3 months, we held it 3 months, then there's 9 months left on that loan. And you see that, you know when it's due. And as you gain experience, you know that most of these loans kind of repay early. You know, they repay on average about 3 months early. So
and can you invest on your platform in a loan late in its life cycle?
Yes, absolutely. As long as it takes to fund it. And we have so many loans now that sometimes we're holding them back, and you know, sometimes they're very short-term loans, so that, you know, it might be a 6-month loan. So you can see some, I think there might even be one on there that has less than 2 months left on it. Right.
And you can invest in that loan.
Yeah, you can go invest.
Just 2 months left.
Yeah. And now it might sell out. You know, the shorter it gets, the more people, they want it, you know, because it's short. And then they see that the property is listed for sale and they're like, oh shit, there's like no risk here, you know, like, yes. So you can really kind of earn alpha. Now the E-REITs are nothing like that, right? No, E-REITs say you got to put in $500 or $1,000. And if you try to redeem it in a year, you know, we're going to dock your repayment by, you know, take away your earnings. We're going to, you know, charge you 2% redemption fee. Or if a pandemic shows up, we're just going to deny it. Right. When will they reopen it? Who knows? I don't know. Whenever they decide, because they're in control. They are in control of your money. And it's okay because they disclosed it. Well, no, it's not okay. There's a better way to invest. Every single individual can invest the same way that hedge funds do today.
So let's talk about investor acquisition.
Sure.
Right? How do you find investors? I've got a dead simple question for you. How much, I'm a wild guess, wait a second, actually, I've not asked the question. How much do you figure, and this is rhetorical because I'm going to actually end with an actual question, right? So rhetorically, how much do you figure it costs to acquire an investor? Through advertising, through overhead, through social media, et cetera, whatever you do, it's got to be more than $10 per investor. So why not just give away $10 pieces?
Well, we do
to acquire investors.
We actually do. In fact, after this, when you post a link, we'll post an affiliate link that
right.
that literally gives you $10 to sign up, and gives both of you $10. So we have an affiliate. We have a referral program that the cost is $10. To us is $20. You know, if you refer your friend and they sign up using your link, you get $10 in your account to invest on Ground Floor, and they get $10 on your account.
That's extraordinary. So I don't much do affiliations, but I'll certainly try that. It'd be a lot of fun. Why not, right?
It's fun. You can donate. You can donate the proceeds to charity. How about that?
Well, let's see if I can advertise. So hang on, that's $10. If I can get conversions at less than $10 on Facebook,
you'll be able to.
You might be in trouble.
Now we know when we're out advertising at scale on Facebook and Google and whatnot, to get a depositing investor costs us, you know, maybe about $100, right?
That was the point I was making.
Yeah.
Yes,
it costs us, if we go out and advertise, it might cost $100. it depends on what we're doing and who we're targeting and whatnot. But the lifetime value of the customer is such that, we make a lot of money on the loans we make. We don't charge investors anything, by the way. No fees. It's free. You earn exactly what we earn. But we charge borrowers for the capital that we provide. And they're happy to provide us a good chunk of revenue, $8,000 or $10,000 per loan that we earn. And those loans are maybe $150,000, $170,000. So if you just do the math, we break even pretty quickly. And if you check out our equity raise on Seed Invest, you can actually see the economics of our business because we're raising capital from the crowd right now, equity capital. And if you're an investor, you think about becoming an investor in our company, you probably want to know, like, how much money do you make? And is it profitable? And the answer is yes, it is.
Perfect segue. So let's talk about Seed Invest and what you're doing right now over there. Tell me a little bit more about that. That's very interesting. Yeah.
So we raised, like most startups in the early days, we were fortunate to access early stage capital from angel investors. And we needed that capital to pilot our concept and kind of hire our earliest team. And that was great. And to build the first version of our product. As we progressed, we earned a qualification from the Securities and Exchange Commission that's only the third of its kind ever qualified. Lending Club and Prosper are the only two that have ever been qualified for an offering that's structured our way. And that's not even in real estate. So we're the only one in real estate. That was 5 years ago. But it took us a long time to get that. When we got that, we earned an investment from a VC firm that invested $5 million in the company. And that really helped us hire a lot of staff, grow our investor base, build up the business. And that was very, very helpful. When we got to about 2017, 2 years after we raised that capital, we started thinking about how we wanted to grow. And we started thinking about our mission. The money that we needed wasn't significant because the business is fundamentally profitable. And the growth opportunity that we saw was significant, but we knew that we could start raising money from our customers every year and giving them a fair share of the profits of the company and the value of the company over time. And that was our goal. So we wanted to live our mission and finance the company in a way that was aligned with our mission. So we took a big risk. We opened up our own equity offering on our own platform in 2017, and it was extremely successful.
Oh, that's right. Yes, it was very interesting.
I guess
around the time I spoke to Emily.
Yes.
Yeah, that was around the time. Yeah,
I think that first round started, we got it qualified in early 2018, and we raised almost $5 million from it. And that was enough to finance a lot of the growth investments we wanted to make that year. And so we came around to 2019, and we did it again. And in
Brian, that was a Reg A, was it? So that was also non-accredited investors.
Yes. And the minimum investment was 10 shares, and our first round was at $10 a share. Mm-hmm. And so, all you had to do is invest $100 to own a piece of GROUNDFLOOR.
Fantastic.
And, I forget, in that first year, I think it was well over 1,000 customers, maybe it was 1,600 customers in that first year actually invested in the company with an average of like $2,700 or $3,000 each, which was really exceptional. Yeah. And that's how we get to that $5 million that we raised in that first year. It worked so well, we did it the next year. Where we said, okay, we're going to raise the price. The price in the second year was $15 a share because the company had a lot more revenue and a lot more value. And once again, we raised about another $5 million.
So what's the vision now? Tell me, what's the vision and where's crowdfunding taking you?
Well, so now we've realized that there are these this didn't exist before, but now there are these other pools and pockets of investors who we haven't reached yet. Because we mostly grow through word of mouth. We don't do a lot of advertising. So people kind of talk about us to one another. And we haven't, a platform like Seed Invest, which is really an excellent equity crowdfunding platform. We talked to all of them, and Seed Invest really stood out. And there were a few really standout prospects out there. There are some really good platforms, but we really wanted to partner with them to expose GROUNDFLOOR to a whole new universe of people who are interested in startups and in real estate investing. And that's working out really, really well. In the first 3 weeks of the campaign, we've had 1.25 million reserved on the campaign. We're expecting to qualify and just do our first close here in the next couple of weeks. So we're qualifying a new offering of preferred stock.
And ultimately your objective will be what? Will be a sale or an IPO, or how are you looking?
For the company long term?
Yeah.
Well, I don't have a hard and fast rule about that, honestly. I think if we found an acquirer along the way who shared our mission, I'm not going to sell out to an E-REIT, right? I mean, you hear me talk, you know that's not what I'm doing. But if we found an acquirer, be it a private equity firm or an existing player in online brokerage or another wealth tech player like a Robinhood or a Stash or one of these guys who have large investor bases in the public markets, and they saw our vision and wanted to invest behind that vision, then I could see us merging or being acquired, right, by somebody else. If instead we have to go it alone, we will, right? We have a powerful enough concept, a long-term enough vision, a big enough vision where I feel like this could be a public company. I mean, we already have almost 4,000 shareholders, right? After this raise, we certainly will. And that's a pretty good foundation to build a long-term viable public company.
And are those shares tradable, or are you pay dividends, or how, like, what's the value prop?
Like many growth stage startup investments, and almost all that I know of, the shares are woefully illiquid. There's no now.
Well, that's why I was asking about an exit. Like how do you, what's the value prop? Yeah.
What we tell people is, look, you should think in terms of a 5 to 7 year time horizon for any startup investment.
Okay.
If somebody's raising capital, it could happen sooner. And maybe we would do a buyback or a secondary or something along the way. But really, as a startup investor, you have to think with a long-term time horizon in mind. And that's why we did a 10 share minimum, right, with our first offering. Because we wanted people to be able to invest for the long term and not take too much risk onto their portfolio. Because startup investments are risky, right? They're very risky, but they can return handsomely if successful. Right. And so we hope to be that kind of shining success. We hope to be a fantastic IPO or acquisition someday. But the timeline that people have to have in mind is long term, and they have to be along for the mission. And they have to know this isn't a dividend paying stock. Growth stage startups don't pay dividends. It's not a real estate investment with a yield. You should go invest in our ground floor notes or our loans, if that's what you're looking for, right? But if you want to be part of this mission and you believe in the long term and you think our management team has done a good job in building shareholder value, then everybody's welcome, right? Please come and join us, right? But it's not a quick flip. It's not a dividend paying yield stock, right?
Got it. So I'll tell you, I'll give you a quick anecdote of my experience of this kind of thing. Then let's sign off with 3 questions I ask everybody. And then I've got a couple of offline ones I want to ask you, just in follow-up to what you said. So first of all, I remember actually I negotiated some shares. I did a deal where somebody wanted me to help them in Japan, right? Basically, I speak Japanese, so I did some negotiating, made a few phone calls. Great. And he said, I can pay you this in cash, or I can pay you 10x in shares. So I'll take the shares, whatever, I'll take the shares. And I sent them to the guy that manages my portfolio, because I don't know anything about stocks and bonds. Right. I have no idea. Right. I sent them to him, and he did something with them. I don't know what he did. And then there was a year or 2 later, I suddenly saw this. I got my statement, and I had this incredibly inflated balance. I called him and I said, how did that? What happened? So he said, I'm not sure. They had a look. And they had absolutely gone to 10 times the 10 times he was going to pay me. So I said, cash out now. I would take those winnings right now.
Good for you.
That's what happens. You invest, you forget, and then you know what? One day you maybe have a good day.
And that's a healthy way to think about it, right? Don't put money that you're counting on to come back to you. It's a long shot. And, of course, I feel proud of my startup, and I know we're going to be successful, and it's my job to make sure that that's true, right? But I think as a skeptical investor, you have to think about it in a dispassionate way, right?
Exactly. All right, let me ask you 3 final sign-off questions. First of all, so you're in the crowdfunding business, and my audience, a lot of my audience are looking to get into that business, right? They're sponsors. Sure. They want to raise equity capital. Yes. So you've had a lot of experience now raising money online. Right. For somebody on the development side, so slightly different, somebody on the development side that's been raising equity all their lives in person, what would you advise them, or what would you say they should keep in mind, the most important thing to keep in mind moving to the online world?
I think the most important thing is to realize that if you're going to do this, you have to embrace a new style of investor relations. You have to view your investor as a customer. You have to dedicate yourself to educating people about not only your company and not only your offering, but about investing in general. You have to be prepared to orient them. And you have to be willing to anti-sell. You have to be willing to tell people why this might not be a good investment. And just like I did, you have to do that, because the truth is most of these private investments, they're not right for everyone. And your job is to help people recognize when it's right for them. And I think, people who've had experience raising money offline will realize that. But that takes on a whole new life of its own when you're dealing online, because online things move faster, information spreads faster, people have different expectations. And, honestly, in a lot of these online campaigns, the dollar figures are lower. And so you're building a broader base. It's like the way political campaigns used to be funded, right? Used to be go to like the big donors, Well, what happened starting in 2008, right, with the Obama campaign, and now with the Trump campaign? It's on both sides of the aisle, right? It's small donations. Bernie Sanders probably the best example, right? But like, no matter who you are, everybody knows it's about a large number of small donations. Well, that's a very different kind of thing from going to the country clubs, and hitting the country club circuit. So I think that's my number one piece of advice, is just be ready for that. It's a more, there's more investor education. There's more, customer service involved, and it pays off in the long run, but it's a big investment up front.
Fantastic. Second question. So you've been online, your world is online for the most part. What's been the hardest lesson you've learned online? Personally?
I think the hardest lesson to learn is that, as an entrepreneur, it's easy to be proud of what you have. And no matter who you are and no matter how much good you think you're doing, there are always going to be trolls. And there are always going to be detractors. Mm-hmm. And what I have learned as a hard lesson is that that's not a bad thing. That's actually a good thing, because the enemy is not the person who's saying bad things about you. The enemy is people who are indifferent to you. Indifference and ambivalence is the enemy. And when people are trolling you, they're actually engaging. And it's an opportunity to be better. It's an opportunity to rise above. And I think that's a hard lesson to learn, because it hurts as an entrepreneur. When people, like when we were first qualified in our SEC offering back in 2015, there was an industry blog over, it was Crowdfunding Insider actually, where they actually allowed the general counsel of a competitor at the time, Patch of Land's general counsel, to write this ridiculous screed about GROUNDFLOOR and about how everything we were doing was marketing hype and made no sense. And it was so offensive. It like really pissed me off, but it also put a chip on our shoulder, and said, fine, we're willing to be misunderstood for a very long period of time. And you have to learn as an entrepreneur that that's what you've signed up for. And when people engage you, even when it feels like shit, you have to rise above it,
I love that you say that. And, the way that I describe it to my clients, because we manage millions of emails for our clients, we do a lot of emailing, and sometimes we get FU emails back.
Yeah.
And so what I say is, we think of the bell curve. Right. The way I think of it is the bell curve, right? What you call the bell curve. In England, we called it the normal curve.
Okay.
Down the middle are those who are indifferent, right? They'll never invest, but they don't mind your emails. They don't mind you talking.
Right.
And then on the standard deviation on the left-hand side, the negative side, 2 or 3 away, there's always that FU is 2 or 3 standard deviations on one side. But because of statistics, you know that the other side of the bell curve, there is somebody who loves everything you're saying.
Right.
Right? So whenever right?
And those are your people, right?
Exactly.
The corollary to this story is
Yes.
that those are your people, and you need to learn how to embrace those people. And one of the coolest things that happened for us along the way is, and this happened with my previous startup, Republic Wireless, which was also a controversial, disruptive force in the wireless industry. One of the coolest things that happened, that had a lot of detractors and a lot of supporters, right, on opposite ends of the spectrum. One of the coolest things that happens is when your supporters show up and defend you without you having to do it. Yeah. And it's really a cool thing. And you got to love that as an entrepreneur and let that be your fuel.
All right, Brian, last of my 3 questions. And before I even ask it, you do not look old enough remotely to even know what a wireless is. My dad used to call it as a radio, but other people called it the wireless. Where's the wireless?
Right. I was in the wireless industry for, 10 years of my career. I'm actually 48. And so I spent a good chunk of my 30s in Silicon Valley and elsewhere in the wireless industry.
All right. So my last question. So online, what are the key daily habits that you have to be successful online?
So the first thing I do every day is I want to see the previous day's data. I want to see our previous day's traffic, investment volume, transfers in and out, and I want to compare that trend. I want to just stay in the flow of that information. That's number one. The second thing that I'm doing every day is looking at customer feedback, and I get that from social media. I'm pretty active on Twitter. I get that from our blog, where right now we're publishing an asset management update every week about what loans repaid and what workouts we're doing, because people are concerned about that. And so I will frequently go over and look at the comments, and I'm not always answering the comments personally, but a lot of times I am. But if our asset management team or our social team is answering, I want to look at that. And then I'll spend some time looking at internal chatter on Slack to really understand what people are seeing from their point of view. So I like to, as a daily habit, be in the flow of information and data. And I think that helps me sort of, it may not change what I'm doing that day, but it definitely changes how I'm thinking about the week ahead. And I think that daily habit is really, really important to stay in the information flow.
Brian Daly, co-founder of GROUNDFLOOR. Thank you so very much for your time today. What an enormous pleasure.
Oh, it was my pleasure as well. Thank you for having me.
That was Brian Daly, co-founder and CEO of GROUNDFLOOR. I have included links to GROUNDFLOOR and to Brian and his online professional profiles on the podcast page for today's episode at gowercrowd.com. And again, if you have a moment, do please open up your podcast player app in iTunes or whatever you listen on, and please leave a review of the podcast if you will. It does help in getting the word out so that other people can also tune in and hear these tremendous insights from leaders in our industry. All right. That's it. Thanks so much for listening. And thank you, Brian Daly of GROUNDFLOOR, for your time with me today. It was a real pleasure meeting you. That is all for this episode, and I'll see you next time. And in the meantime, stay well. And for now, this is Dr. Adam Gower signing off.